Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Hi everyone, how you going? Welcome to the Smart Property Investment Show, and we're back. It's a portfolio update, and we haven't done one of these for a little while. I know they're very popular, and I've been getting a lot of emails coming through saying, Phil, when you do a portfolio update, it's been so long, you're not saying much at all. What's going on? Are you still buying property? So I do pass on my apologies that I haven't been as diligent as I could do with our portfolio updates. We're going to get back in the swing of things. One of the main reasons why we haven't been doing them is because we haven't been doing too much at all. And if you listen to the last time we did, I was saying very much similar things. When you look at, since the last time we've done something like this, and with my guest in the studio today, who I've thankfully managed to drag my accountant back after many, many months. He was last on, I think, in February when we got together and had a good chat around where we're heading. Munzurul from Keshab. He's back, and we've just spent a good couple of hours going through our portfolio, and we thought we'd go straight on while it's fresh in our brains, have a chat about our portfolio, where we're going, how we see the world, how he sees the world, his fears, and where he sees the opportunities. He's here. Munzurul, how are you going?
Very good. Thank you very much. Good to be back.
Potentially, Munzurul, one of the most popular guests we ever have. You are. People, for some reason, like the podcast that you come on. So we should get you in more.
Thank you.
And, around this side of your portfolio update. And if you're new to the podcast, just a bit of an origin story. One of the reasons why we created Smart Property Investment way back when was to give a warts and all look into how to invest in property, sort of drawing on the views and opinions of the experts, but doing it ourselves. We felt that there was a lot of BS in property investment stories of how some young 25-year-old become a bazillionaire overnight, and we just went, look, that's not the way it really works. So we just really wanted to be a source of information to make more informed investors. And as part of that story, we said we'd start investing in property ourselves. So if you go and check out smartpropertyinvestment.com.au, you go and see, click on the Our Portfolio tab, you'll see our portfolio. We've been chatting about it for years and years, sometimes really intensely, some less so, and we've been in a less so market for the last little while, but the stories there on renos we've done, properties we've bought, where we've stuffed up, where we've done really well, and Munzurul's been a big part of that journey over that time. So as it sits right now, we've got a reasonably sized portfolio. There's 18 doors, so 18 different properties which are generating income for us. We haven't really added to that for a little while. Some of the last stuff we bought was up in Queensland, where we bought an apartment block, 5 units. And we've been really in a holding pattern, some would say consolidation phase over this last period of time. And when we last got together, Munzurul, we were chatting about how the portfolio performed over a period of time when you had negativity in property markets, so going backwards rather than forwards. And we sort of determined over that period that we probably lost about 1.4% of the value of the portfolio?
About 1.7, that's right.
1.7%. And what we've established through our discussions today and some of these valuations that we've done, that we've bounced back from there, and we've had what sort of growth on that from that period of time from earlier this year?
Yeah, looking through the portfolio in the last, say, 8 months or so, based on the valuation, the tentative valuation that we have, we seem to have increased about 2.3%. And in terms of the actual dollar value, there is an increase of 128,000 in terms of net equity, and that's pre-tax and pre-cost in terms of selling. And if we look back into the first sort of the 9 months, the prior sort of the review that we did in February, we lost about 125 grand at that stage. So we lost about 125 grand because of the market, and we seem to have bounced back by about 128 grand.
So many people see you as a brains trust, the oracle when it comes to what's happening with property investment. I'll get into the market a little bit later in the podcast. I know people are going to be going, we want to know what Munzurul thinks about what's going on at the moment. So we'll park that idea. And for the first part of the podcast, we'll just chat about our portfolio. And to my point beforehand, we haven't been particularly active with this portfolio. And there's a number of reasons why. When we got together last time in February, we didn't know what was going to happen in the election. We didn't know what was going to happen with negative gearing. We didn't know what was going to happen with CGT tax concessions. There were a lot of unknowns at that point in time. Do you remember back then, and were you thinking the same way in your portfolio, or was it just us really with those concerns and issues and a wait and watch approach?
Mate, absolutely, wholeheartedly, because I look back into my own portfolio, your portfolio with my client side of it as well, right? There was a whole lot of negativity, as you said. So to start with is that whether the Labor government was going to come in, whether negative gearing was going to be taken away, whether the CGT discount was going to be reduced from 50% to 25%. Then you look into the APRA and you look into all the sort of the restriction that the APRA had. I go back a little bit earlier and I sort of say in November, December, when we all left for Christmas, the overall view was that the interest rate was going to increase in 2019. And I sort of look back now and I sort of say that how quickly the world has changed in the last 4 to 5 months, and all this negativity has been transformed.
So do you think we should start being more positive and proactive now with our portfolio?
We do, and I do believe that, in a conservative manner as well. And the reason I say it is that while the interest rate is very low, it's only about 0.75%, the RBA is the interest rate. Whether the interest rate is going to reduce even more means that there is a lot of positivity in the market. You just simply look into the auction clearance rate in some of the states and very, very, very high. So there is quite a bit of positivity. So one side of the view is that perhaps the upswing on the market that we're sort of seeing, it's just the beginning of that upswing, and whether there is a good period of time that upswing will continue. So that's an attraction. The other side of the equation is that I'm also become reasonably conservative, saying that, well, interest rate can only go down that much and can only stay low for that period of time, and whether there is a floor to it, and when they increase, whether they increase rather quickly. And if they do increase rather quickly, one sort of considers that whether there should be a bigger buffer that we sort of consider. So the answer, I suppose, in my mind is that we need to be optimistic at this period of time in a bit of conservative way.
Okay, so let's run through a couple of headline numbers for those of you who might be new to us discussing our portfolio, or for those who are really interested in where we're at with stuff. So total vote, so there's 18 properties, or 17 properties, 18 doors, one's a duplex. There's 9 of them are in New South Wales, 8 in Queensland and 1 in Victoria. We hold all of these properties in trusts, which has its own benefits, but also its own negativities. Out of those assets, 8 houses and 8 units / townhouses, villas. So that includes 5 in a row, a block of apartments which are all individually strated. Top line, $7.4 million in valuation and about $5.03 million in debt. So you got $2.4 million in total equity. So if we want to refinance our whole portfolio at 70%, we could pull out 146K, at 80%, 800K. So we'll have a chat about what that means in a moment, about what the future holds. But by and large, that portfolio, Munzurul, what's your feelings about it?
But we've done well. And if we look through and we have the overall sort of the perspective from day one when we started. So you're running this portfolio for about 9 years or so.
Yeah.
And one sort of argues that you started with about 250 odd grand as an initial sort of a cash contribution, which we've sort of drawn back.
Yeah.
But if we sort of say that, well, 250 odd grand cash, and that 250 odd grand cash over a period of, say, 9 years, that sort of reached into a $2.4 million net asset. So the gross asset value is 7.4, as he said, with the mortgage attached to it, to 2.4. Now, when I do the maths in terms of the compounding return, and the compounding return over that 9 years is about 29% compounding return. So that's a very, very, very strong compounding return. What's interesting is that I've got the statistics that we go back to all the sort of the prior podcasts that we did. Our compounding return was higher. And it is expected to be, because as the number sort of grows, your actual compounding return as a percentage is expected to drop. But 29% over 9 years, I'll take that anytime.
And if you're a bit confused by that, I'll try and break it down for you, Munzurul. Please tell me if I get this right. So this is on the assumption that we put 250K in cash into this portfolio to create the portfolio today.
That's
now,
right.
To what Munzurul said, we've actually pulled that money back out over time. So it doesn't owe us anything. But let's just, on the assumption that 250 was the initial cash outlay.
That's right.
That means every single year it's grown by, that 250 has grown by 26%. 29%.
Compound.
So the first year, 29%, 29%, 29%. So with that money, we've created $250,000 into $2.4 million in equity over a period of sort of 8-9 years. That's pretty good going.
And compounding return as well.
Return.
So not only the 29%, it's the 29% on the 29% on an ongoing basis as such. So very, very good return. And we compare with sort of the standard sort of any other shares, managed funds and so forth. And I say that all along, that wherever the experience is one go for it, and one have the passion and one can do well. But whatever way that one sees the investment world, 29% over a period of 9 years is pretty good going.
Now, I know the naysayers are out there, Munzurul, just going, yeah, that's all well and good because you're in the Sydney market over its biggest boom period over a period of time. And we had considerable exposure, 9 properties in New South Wales, so most of them within the Sydney metro area. That's a fair call though, isn't it? We bought at the right time and we got the benefits of a significant uplift in the market.
It was selective buy, and it was selective buy, and it was deliberately being bought in Sydney at a point of time when there was some underlying merits behind it and science behind it as such. And if you look back into your portfolio, you see that you bought quite assertively in Sydney for a period of time, and then you sort of didn't buy in Sydney that much.
Yeah.
When the prices sort of to a great extent sort of overshot and the rental return sort of wasn't sort of keeping up with the prices as such, and you deliberately went back into the Queensland market, you went a bit more in Victoria market as such. So it was definitely sort of buying on the basis of the underlying sort of the science as such. But yes, the market sort of helped.
Well, the market helped, but for those people who say, well, the only reason why you've had that good growth is because you bought Sydney at the right time. Well, my response to that would be, yeah. And we could have been buying in Brisbane at that time or in Tasmania at that time, but we didn't because those markets didn't show us the fundamentals of where we should be buying, and we've benefit from the uplift of the Sydney market, and then we've moved our strategy as a result of that, and we stopped buying in Sydney, to your point. So, it's simple, buying the right market at the right time.
And absolutely 100%. And if we look through it with the period as well, that it is over a 9-year sort of period as well. So it's not over 1 or 2 years. So it is relatively one cycle, one can say.
So when we come back, we're going to run through some of the cash flow factors of this portfolio and just give you a bit of inside read on what we're looking to do next. Back in a moment. Welcome back. I'm here with my accountant, Munzurul Khan from Keshab Chartered Accountants.
That's it.
What's a chartered accountant mean? It's different to a CPA.
They're two different bodies. So you've got the Institute of Chartered Accountant and you've got the Institute of CPA, Certified Practicing Accountant. They're both sort of more or less similar.
Okay, but you like being a chartered accountant.
I do indeed.
So we're just running through some of the top line growth figures and debt position on the portfolio. Now, Munzurul, when you look at the spread of property investors in Australia, I think there is only maybe 20-odd thousand Australians that own more than 6 investment properties. So we're talking about a portfolio here of 18 properties. So it's on the larger size, right? It's not like a standard typical property investment. So it's on the larger side. So, when I sometimes look at the numbers of cash flow on this, sometimes in absolute terms, I start sort of going, oh God, that's costing us a fair bit of money. What I mean by that, for the 18 financial year, with some ups and downs and some not so good administration on my behalf with, places going empty for a while because I've been busy, we were about 68, 69, let's call it 70 grand negative cash flow for that period of time. So to break that down, before tax, it costs us $70,000 to hold this portfolio. We're getting good compounding growth, so that's okay. So that equates to about $3,800 per property per year to hold it, or $74 a week. So it sounds like a lot of money. We had to chip in $70,000 into this portfolio just to maintain it, keep it and growing. But with size becomes bigger numbers, right? How do you feel about that cash flow position on the portfolio?
The 2018 was not the best of the year from a cash flow side of it. So it was about 70-odd grand. If we look back in 2017 as an example, it was about 46. 2016 was about 56 and 2015 was about 28,000.
Yeah, because we bought a bit as well during that period.
That's right. Yeah. So it was definitely on the higher end. That's point number one. And the point number two, I suppose, is that while we do sort of say that, well, it's about 70-odd grand, divide that by 18-odd, so we're sort of saying about 3,000, 4,000 per property as such, there's a bit of a tax benefit attached to it, whether it is depreciation, whether it is sort of the negative gearing as such. And once you take the depreciation and the negative gearing, the numbers are much better.
They are much better, and hence the reason why we were happy when negative gearing, like most Australian investors, wasn't tinkered with at the last federal election. It looks as though we've got some pretty good runway now. I don't think they'll do much to that for some period of time, and whether or not the Labor will enter any new election on the basis of putting that in one of their policies, I'll be interested to see, and we'll work that out in about sort of 3 years' time. But our post-tax position on this portfolio is about 35 grand a year. It's costing us, which about $37 per property per week, which, you know what, I can live with that. It's all right. It's not really hurting too much to do that. And do you see that a lot in property investors? They can sort of manage that sort of negative cash flow?
I do. And sort of expanding that sort of number a bit as well, because if we take that over a period of 8 years that you're sort of investing up until 30th of June 2018, and the 19 numbers where we're still sort of finalising. So up until 2018 is that when we sort of look through, is the net after the tax benefit is about 150 odd grand sort of a loss. So if I divide that over 8 years, it's about 18 odd grand.
Yeah.
And that means post-tax it is about $1,000 touch bit more per property.
Okay.
And then you sort of compare that with sort of the growth that we had over that period of time, and the numbers are very, very different.
It is. And, if you're going to be a naysayer and say that portfolio is not performing very well, how would you handle that?
Look, I would say that you started with a certain amount of cash, which we have drawn down a bit of the cash. And the cash that we started with was about 250 odd grand, and we've drawn down. So we really have started with no cash, so to speak. But if we assume that we start with 250 odd grand, just to get some numbers, you still had over 8 years, 9 years, you still had about 29% compounding growth, which sort of reached into about 2.4 mil. So I sort of say that, 2.4 mil in one side, on the other side, perhaps there's about 150 odd grand net cash flow that we've lost. We would like not to lose it, but 150 grand loss in one side and $2.4 million profit on the other side.
It's not too bad. And some back in the envelope calculations we've done, we're going through the process now to try and reprice some of the mortgages in one of these trusts in particular, which is on the high side. So, some of our interest rates are sort of 5.2, 5.3%, right, which is high when, we should be getting very low fours, maybe high threes. If we can shave a percent off $5 million worth of debt, that's 50 grand a year. Is that calculation
that's
right?
about 50 odd grand. And in terms of the numbers that we sort of share, the numbers are all inclusive numbers. So it includes your land tax, it includes your accounting fee, it includes your running cost, administration cost and setup and all the rest of it as well.
Yeah. And land tax is where we get hurt. And we've spoken about before when we're doing these portfolio updates, for those of you who are new though, because we invest in trusts in New South Wales, we get no benefits from land tax exemptions. So we pay land tax on every single dollar of land that we hold in because we hold in the trust. So I think that sort of costs us $30,000 to $40,000 a year just in land tax, right? That's a big bill.
It is, unfortunately it is. And land tax is one of those sort of the dreaded tax, right? So in trust, you've got no land tax threshold. Now, it's a deliberate decision, I suppose, we made. And we made that decision on the basis of, one is the asset protection. Because the trust is sort of, you don't own it, you control it. And the second reason why we've done it is more in terms of future tax planning side of it, because the profit effectively can be distributed at a discretion through the unit trust and going back to the unit holder, which are the family trust in our circumstances. So quite a bit of tax flexibility as well as the asset protection on the other side in New South Wales. There is no threshold. In Queensland, there is a little bit of threshold, about 350 odd grand in trust. But again, the threshold is lower than individual.
So you never get it all your way, right? There's pros and cons with any strategy or any tax structure.
And you make that a commercial decision on a balance. And the commercial decision is in relation to the asset protection, tax planning. The land tax by itself is a tax deductible tax. So we can claim that as a deduction as well. And you sort of say that, we as an investor as a profile, that what are the things which are priority? If the asset protection is priority and the tax flexibility in the longer period of time is priority, then we sort of, I suppose, take the land tax along the way.
So what else are you seeing in the portfolio at the moment, Munzurul? What are you liking? What's sort of making you a bit nervous? Where should we be concentrating, do you feel?
Yeah. So the diversification is something that I speak quite a bit with the portfolio, quite a bit. And I sort of say that even though we could be one asset class, which is investment properties and residential properties, even that can be diversified quite a bit. So we do have a little bit of diversification in between New South Wales and Queensland, whether further diversification can be done in Victoria as such. So that sort of is a question. And the second question, I suppose, is that there are quite a bit of unusable equity on our fund at the moment, and unusable in the sense that we haven't utilized them as yet. And I suppose the question is that what are the potential and what are the plan?
And there's something for us to work through, but to your point, you view it as not getting good utility out of your equity. So what you're saying is that there's too much equity in the portfolio. We should be leveraging that to keep growing the portfolio. Right. And that's just your attitude to how you invest. And everyone needs to have their own risk position, and our LVR is sitting at sort of 76% or somewhere or other.
Around that sort of figure.
So you're saying there's some lazy equity there that could be working harder for us.
That's right.
Why would you say that's an aggressive view? Would you say that's just your particular, knowing me as a client, knowing the way I see the world, knowing my capacity to earn? Are you saying that I should be a little bit more aggressive in how I build out this portfolio?
Very, very, very good question. And the answer to that question, very good question. The answer depends on the individual investor. The answer depends on, yes, the risk profile. The answer depends on the age bracket of the individual. The answer depends on the smart goals of that individual, is that where do I see myself, what period of time, and how do I see myself as such. The answer depends that whether we are in a consolidation stage, whether we are in an acquisition stage, whether we are right at the end at the retirement stage as such. Now, in our circumstances, depending on, I suppose, how we see it, what we see is that we've got many more years, should we choose to.
I hope so.
And and there is quite a bit of equity being on sort of the portfolio. So at 80%, there is easily about 800 odd grand sort of one can draw down potentially, whether we draw down all of it, whether we draw down part of it. And then if I look through into the market and I sort of say that, well, the interest rate is so high, the auction clearance rate is so incredibly high in some of the eastern sort of the states, particularly, the market is an upswing. So there is a bit of increase in the price that we're sort of expecting. And the question is that whether we want to be the part of that journey.
So when we come back, let's have a chat about the market, Munzurul, because I know you probably spend every minute of every day that you're not actually doing client work, thinking or breathing property. So we'll get into that. And I know you're my go-to guy when it comes to this sort of stuff. Back in a moment. Welcome back, everyone, here with Munzurul Khan from Keshab, my accountant. We're chatting through our portfolio, just giving you a bit of a portfolio update. And I think, as we probably just alluded to then, there's a bit of inverted commas, what Munzurul would call lazy equity that could be working better for us to give us, some greater growth or uplift in this portfolio. And I guess that's sort of juxtaposed, sorry about that word, but with the current market, you've got the lowest interest rates ever. We just had another rate cut earlier this month. So, 0.75% is the RBA cash rate. Investors should be able to get, depending how big your portfolio is, at high threes, sort of really low fours. So money's cheap right now. What are you seeing? Is now one of the great times to invest? And why would that be the case, Munzurul? And where should you tread with caution?
So good question. And we look through in terms of short term, and we look through in terms of medium term, and then we look forward in terms of very long period of time on the basis of our individual goals and objectives. So if we start with the short term, we sort of say the RBA is about 0.75%. The interest rate with all the banks are relatively lower, and the banks are, if anything, potentially in some level of competition within themselves with the new sort of the business as such. The APRA has taken away some of the restrictions. There's still some restriction in there. Many level of negativity that we had in the market, say even 6 months ago prior to the election, with various different things that perhaps they're not there anymore. I mean, there are some tax cuts came through as well, not significant amount. Nonetheless, there was a perception of the tax cut, and there are some first-time buyers sort of grant and some incentive being provided. So you combine all of those, the first-time buyers, the tax cut, and all those negative gearing and CGT discount, they were supposed to be taken away. They haven't been taken away. The APRA has uplifted some of those. You add away all of those, and you sort of see that the market has got enormous level of positivity on the market. Now, that has both strength and that has also challenges as well. And strength and, I suppose, positivity is that one probably expect that the market would have rather sort of an upswing. And one can only justify that, if nothing else, if looking through the auction clearance rate as an example. In New South Wales, in the last 5 or 6 weekend, the auction clearance rate was in high 70s. And you look into Victoria, and the auction clearance rate was about mid-70s as well. So very, very high. So that is sort of the upswing. So one probably expect that the market potentially will increase quite a bit over a short period of time. But at the same time, one has to be relatively conservative in the sense saying that, well, are this low interest rate going to be there forever? Would there be a period of time where the interest rate does increase, whenever that can be? And when it does increase, is it going to increase rather quickly? So my personal sort of the investment journey at the moment is that, yes, it is quite a bit of optimism, but at the same time, it is probably equally important on 2 things. One is to have the adequate level of buffer when the interest rate does increase, if it does increase. And number 2 is not so much doing the maths completely on a very low level of interest rate. Add away 1.5% to 2% interest rate on top of the existing interest rate that you pay, and see that whether you can genuinely afford it, and then is the market.
So the banks were doing that for us most recently, and they've dialed down their serviceability requirement. They were servicing mortgages at sort of 7%, and it's sort of back down to sort of 6.5 or around that mark. So you're saying that even if you're getting money at 4%, you should still be doing your sums on at least sort of 6% to make sure you do have the buffer and you can sustain should there be changes to interest rates moving forward? Is that the best way to proceed?
Very in a safe way, because we, as being the investor, we are not in the market only for the next year or for the short term. Next year, whether it's going to increase 2%, hardly. If anything, it may even drop. But we look back into the interest rate and we sort of say, what's the average interest rate in the last 10 years? And what would be the prospective average interest rate in the next 10 years? And one sort of says that it has to be a lot higher than where it is. And it's just safer doing the maths in that way.
And to the other point you made around buffers, there's a buffer. So you talk about doing your calculations at sort of 6 odd %. That's cool. I get that. I agree with that. But does a buffer necessarily need to be a cash buffer? So should you have cash set aside at any given time for a rainy day or some particular issue? You know, it doesn't make sense to have cash sitting in an account getting at best in a term deposit. If you're getting the %, you're probably doing okay, I imagine, right now. So can cash sit in inverted commas liquid property that you can shift quite quickly, or is your buffer best sitting in an offset account to try and reduce your exposure to some of your debt? What's the best way to keep that buffer?
That's right. And depending on, again, the investor sort of the profile as such, right? In my personal circumstances is that the definition of the buffer that I sort of see are the liquid available funding that one can draw down if one needs to. Now, in an ideal world, all of those funding should be sitting into an offset account. That, to my mind, is sort of the best option. And the reason why it is that probably the best option is that one is that sitting in the offset account, it's saving you the interest that is sort of getting charged. And if, let's say, someone has the principal place of residence, that's even better, because these are the non-deductible interest that you do. That's option one. The option two potentially could be is that if it is not in the offset account, as long as it is some level of redraw facility, whether it's a line of credit that, yes, we've got a redraw facility, whether it's an equity loan already being approved, we haven't drawn down, that is also is a good option as well. Now, that to me is the buffer. The question also comes in, I suppose, Phil, is that how much is enough and what do we need with the buffer side of it? No one answer. As a rule of thumb, the accountants very often sort of say that perhaps about 3 months or 4 months of sort of your overall expenses is that if you keep that as a buffer, that sort of is a start.
So total mortgage repayments without receiving any income? That's a big number.
More the out-of-pocket expenses,
Okay.
right? So let's just say that you've got a certain level of portfolio and let's just say, argument's sake, the portfolio sort of cost you about, say, 10 grand per year. So your sort of quarterly on that example is hardly about 2,500, right, on that example. So a net in your hand as a 3 month, and then 3 month in my mind is probably at least what we do, and then perhaps whether we go 4, 5, 6 months. The balance is equally right, equally important, because if you have too much buffer, then whether we're utilising the fund in the right way too.
It's such a fine balance to get right around having access to capital quickly that's liquid, whether it's in a redraw facility or some sort of offset facility, or even you might want to park it in stocks and shares, which are blue chip, but, you know, a bit of risk on that versus that money being lazy and not working for you. So if it's sitting in an offset, you're getting 4% on your money. That's not too bad because that's the deduction on the mortgage rate. But, you know, that same $100,000 might be parked in property, which is giving you a compounding return of 29%, right? You know, which is sort of what we've been seeing in our portfolio. So how do you work that balance out? Just what's right for you and allows you to sleep at night?
That's right. What's right for you and allows you to sleep at night. But as a rule of thumb, if one sort of starts about 3 months, and then one sort of says that, well, whether the 3 months sort of goes about 5 months, maybe 6 months. And the way we sort of rationalize it is that what we're sort of saying is that there is no sort of our active income for a period of time. And the question is that if we don't have an active income, if I'm in between employment and if a rental property, the rent is not there, what is the practical time for one to get that second employment or the tenancy movement? And one sort of says, you know what, 3 months to 4 or 5 months is perhaps sort of reasonable.
Do you, what's your views on like income protection insurance on that basis? If you lose your job and insuring against it, are you a sort of advocate of?
There are merits to it, right?
Yeah.
I mean, of course, there's merits to it.
We're not giving advice here, by the way. This is just a general conversation, but...
And there are merits to it. And the merit is that if there is an income protection insurance, provided that you sort of meet all the clauses and terms and condition with that income protection insurance, then one sort of gets paid within a period of time when the employment is not there. It does give an assurance. On the other side of the equation, I suppose there is a cost involved. The cost is tax deductible, which sort of makes it a little bit easier. So it sort of makes it a little bit easier, but it comes back to the individual profile, yeah.
So what are you seeing in the market at the moment, Munzurul? I know you live and breathe property. To my earlier point, you do it from the eyes of an accountant, but the skills of a property investor who's quite experienced and well versed in this regards. And to echo your sentiments beforehand, the current market offers a number of really good opportunities, but you also need to tread with a degree of caution because it's not always going to be as it is right now. So you need to make sure that you operate within those confines really well. Where are you looking? What are you seeing? What sort of stuff do you like? What sort of stage? And you touched briefly on auction clearance results, and there's some fluctuations in them, like Sydney versus Victoria versus South Australia. But some of the other headline economic indicators would also indicate that, look, it's not going to be glory days ahead, and we need to be sort of cautious about an evolving global economy and its impact on Australia. But where do you like, and what sort of stuff do you think you're going to be reasonably well off on if you sort of start concentrating on it?
I think this is a really, really important point that you touched. The interest rate dropping, it's not actually necessarily is a good news as an overall for the economy, right?
Yeah.
Interest rate is dropping because there is a reason why the interest rate is dropping, and the Federal and the Reserve and sort of the economists are concerned that perhaps the market needs a bit more boosting as such. So we have to take that into account, that we as an investor, we sort of say, well, interest rate dropping means that we got a bit more cash flow, but it's the market, yeah. So I always look into the underlying sort of science behind the property, right? I sort of look through saying that, well, I'm buying this particular property. What's the return that I'm receiving, the gross return? What are the expenses associated to it? And what's the bottom line net, either positive or negative cash flow? If it's negative cash flow pre-tax, set aside the tax as a bit of benefit and a bit of a bonus as such. And we sort of say pre-tax, how much is it costing in my hand per week as such, and how much am I comfortable of costing that per week? And the question also comes in is that what is the level of the interest rate that we use? So I would personally use probably easily about 1.5%, if not 2% higher than the interest rate that they are at the moment. That's being conservative, that's being historically being balanced and average over a period of time. And if we do 1.5% to 2% sort of higher than what the interest rate is at the moment, if we are comfortable that that is the overall negative cash flow and quite easily maintainable from my point of view, and the buffer is there, then the investment is right from our end.
So we're not going to give sort of specific property advice and locations. That's not what you do. You're very good. One of the best I know at sort of the accounting associated with building out a portfolio and how to go about doing it for long-term strategic growth. But, in this current market and where it's heading and what we all do as property investors, there are so many unknowns. And one of them is, interest rates at all-time low, but some of the criticisms coming out, and they're talking about a ACCC investigation into it, is that the bank's not passing on these changes to the cash rate. And to your point there, a really low interest rate doesn't necessarily bode well for the economy because it means that the regulators are looking to inject more cash back into the economy so people to spend money because they're not spending so much on their mortgages. And if the banks don't choose to pass that on, that's a particular problem. So, I don't want to get necessarily into property investment advice and locations and stuff, but what's your feeling or sentiments towards banks' appetite to negotiate on rates? If you can always call them up and say, hey, look, give me a better rate, right? Like, is the appetite there at the moment?
Much better.
Yeah.
Definitely much better as opposed to where he was about, say, 6 months or so ago, right? So 6 months ago, it was quite a bit of doom and gloom and wear and tear, and sort of fear factor was going around quite a bit with all around. I think many of those things being settled quite a bit, and it is definitely much better. While it is positive, I actually take that as quite cautiously from an investor's point of view, that we can get funding from bank also necessarily doesn't mean that we need to get the funding from the bank. The question is that whether that funding is right into my sort of circumstances as such.
And what are the best investors doing to prepare themselves to create the best position to secure financing right now?
Yeah, look, I mean, believe it or not, diversification in the financing, in my mind, is also rather important.
Okay.
That whether we sort of go through with one bank, whether we go through with multiple banks as such, is number one. And number two is that from the investor's point of view, it's about presenting the information in the right way to the bank. And particularly if the investor has a number of a structure, whether it's trust, whether it's corporate entity, whether it's individual, and whether it is other entity as such, it's very often the simplifying way of presenting presenting that information to the bank, saying that, well, yes, there is a salaries and wages, there is a profit, there is a retained profit, and there are some trust distributions. So you add away all of those things, my consolidated income is this. So presentation of the information is very, very important in my mind. In my mind, it's also sharing your goals and your dreams and your vision and your business plan, so to speak, is very, very important as well. That whether the bank are comfortable in terms of what you are doing, what's your track record behind it, and where are you investing? So all of those things comes in, and from all of the above matters, the mortgage broker comes in so fundamental working with yourself.
Yeah, pretty important mortgage broker, and I've long been an advocate of a good mortgage broker. It really helps out. So, Munzurul, this is a portfolio update, a smart property investment portfolio update. We've just sort of picked your brain on some of the sort of wider sort of economic factors which are shaping the environment for investors. But sort of stepping back into our portfolio, and I'll close with this theme. When we get together in another 6 or 9 months' time, what would you like to see from us and our portfolio?
Good question. And I must start saying that it depending on the individual, sort of the preference and how we see the portfolio and so forth. If it were my individual portfolio, some of the things that I'd be quite curious in my mind is to say that, well, there is a certain amount of sort of equity being available within the portfolio, whether a portion of that equity can be extracted, and depending on the profile, how much we can extract. At 80%, we've sort of done a high-level math saying that about 800 odd grand that we can extract, whether we do 800 or a portion of it. And then the question is that with that sort of equity, what does one do? So whether one sort of buys the traditional sort of property, whether one sort of buys some property which has got a bit more sort of a growth potential, whether one sort of buys a property which has got a bit more manufactured growth potential as such. The question comes in is that whether diversification can be taken at a little bit more sort of a sophisticated level. We've got lots of residential properties, whether a commercial property has got place. And the reason why one says the commercial property is that it works very well with sort of the growth potential property where your rental return perhaps may not be as high. So the balancing of it perhaps is not that bad. So those are the things that I would like to see in the longer period of time.
Okay, so we'll work on that and make sure that we keep driving forward. I think, to some of your points, the lending environment is getting a little bit better for property investors. Yeah, interest rates are obviously down, so if you can get a mortgage, it's normally a pretty sharp rate. And there is a level of competition which is emerging between the banks now that some of the shackles of APRA recommendations or regulations around caps on loans to property investors. So, there's a lot of competition coming back into the market. And I'm seeing a lot of that but within the big four banks, but also some of the sort of second-tier lenders and building societies and non-bank lenders. They're pretty hungry for business right now. So it's a good time to be seeking finance. But, it's about preparing and packaging up and presenting the best possible picture to a lender so they're happy to lend you money. And that's something like, if I put it all together, we're okay. But it just takes time. That's what I've got to work on.
It does indeed.
Nice one, Munzurul. So let's get in the diary. Let's check back in about 6 months' time and have a chat, and we'll pick up on where the property markets are right now. We've got a lot more stability. Yeah, it's probably a fair word. A lot more stability in markets right now, considering, well, for property investors at least, considering all the knowns around government policy towards negative gearing, capital gains tax, concessions, some of the rules around SMSF lending, which we sort of touched on really briefly, and a softening in some of the requirements coming from the banks in terms of serviceability. So it's a lot better than what it was when we last got together, and hopefully in 6 months' time it's better than where we are now.
No, absolutely. Look forward to it.
Thank you, Munzurul. I do appreciate that. That's Munzurul Khan from Keshab Chartered Accountants. He's my accountant. I use him for all my property stuff and personal wealth creation. So it works well. I do enjoy these conversations, and it sort of just gives me another kick in the backside to concentrate on this stuff a little bit more. So I bring Munzurul onto the show. I'd like to do it more regularly. And if you'd like us to get him on more often, happy to do so. If you've got any specific questions, we can do ask the accountant anything, and you're happy to answer anything, Munzurul, around tax and tax-orientated property stuff. You're okay?
I'll try.
You try your best. Let's do that. So get in contact with the team here. with your questions, editor@smartpropertyinvestment.com.au. We'll curate all them together and we'll do a Q&A session with Munzurul. It can be as heavy as you want. We can talk about trust structures, distribution of income in trust structures, all the way through to how to set up your first purchase and do it the right way and planning for the future. So we'll definitely do that. Let's put it in the calendar, send them through. If you're not yet subscribing to Smart Property Investment, you can do so smartpropertyinvestment.com.au. You can subscribe to our morning newsletter, just smartpropertyinvestment.com.au/subscribe, or social media, search Smart Property HQ. If you like what we're doing, get in touch with us. Let us know your feedback on that email address. Otherwise, leave a comment, or you can rate us wherever you're listening to this right now. We like the 5 stars. That's what the team really get a good kick out of it. But any constructive criticism, I'm happy to take on and evolve the show. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.